They told you it was impossible. They said Canadian real estate only ever goes up, a guaranteed investment, a permanent path to generational wealth that could never be threatened. For years, you watched your neighbors become millionaires on paper, fueled by historically low interest rates and a relentless, illogical surge in home values that completely divorced itself from economic fundamentals. But here's the truth that every bank, every economist, and every over-leveraged homeowner is praying you don't discover. The financial air is violently escaping the housing bubble, and the collapse is mathematically certain. The forces of correction, which started as a minor tremor in late 2022, are converging into a deafening roar set to peak throughout 2026. This isn't a mere slowdown or a modest retraction. It is the inevitable collision of three catastrophic economic pressures that define a true crisis. First, the Great Mortgage Renewal Shock, a devastating tidal wave of 5-year mortgage terms, secured at rates as low as 2%, that will suddenly mature and renew at current market rates, potentially triple their original cost. This astronomical payment spike will immediately render hundreds of thousands of highly leveraged homes instantly unaffordable for their current owners, forcing a massive volume of sales. Second, the inventory avalanche, where desperate individual sellers, alongside panicked institutional and private investors, flood the market with listings, shattering the long-held myth of perpetual scarcity in Ontario. And third, the affordability chasm, which has permanently sidelined the critical mass of young, first-time buyers needed to absorb the rising supply, regardless of modest price cuts. We expose the 10 cities that are the most exposed to this perfect storm, the epicenters of financial vulnerability, standing on the edge of the deepest, most shocking price crash in a generation. If you own property in the Greater Golden Horseshoe, or if you've been waiting for a chance to finally buy, you cannot afford to look away. You are about to see, in excruciating detail, which cities will feel the pain the most, and why their collapse is a debt-driven necessity. Our journey into the core of the correction must begin not in the urban metropolises, but in the distant, illiquid markets that experience the most irrational and volatile price gains. These regions were bought up sight unseen by Toronto and GTA residents who chased square footage during the pandemic, fundamentally warping local pricing. City number 10, Sarnia Lambton, and City number 9, Bancroft and area perfectly illustrate this critical risk factor. Did you know the length of your commute could wipe out a quarter of your home equity? The illiquidity of the periphery markets means the crash hits harder and faster. The fundamental mechanic of the crash here is illiquidity amplified by price overextension. During the 2021 peak, demand in these regions was artificially inflated by a temporary influx of buyers with substantial GTA equity and the freedom of remote work. As the national economy moves toward a definitive return-to-office trend, this critical source of external demand has vanished entirely, leaving a massive vacuum. What remains is a small local buyer pool whose wages and local financial capacity never came close to supporting the peak prices, facing a sudden, dramatic surge in forced listings. This rise in inventory is driven by pandemic buyers who are either choosing to relocate closer to work due to mandatory office days, or more critically, are facing the imminent mortgage renewal shock. They cannot service their highly leveraged loans based on the lower local income levels and are compelled to sell at a loss. Furthermore, the appraisal risk in these areas is severe. As the first few distress sales occur at steep discounts, subsequent appraisals for financing new purchases will be immediately devalued, choking off what little remaining buyer activity exists. Because these peripheral markets lack the robust, diverse, and deep demand pool of a major metropolitan area, inventory sits for months on end. This creates a panic environment, compelling sellers into steep, cascading price drops and extreme concessions to be the one property that actually sells, a true crash dynamic destined to pull prices back toward their more sustainable 2019 baseline as speculators and over-leveraged remote workers are forced to liquidate their holdings. Next, we shift to the critical secondary ring of Ontario's major population centers, places that became the primary destination for price-sensitive buyers and speculative investors, markets where the risk of leverage overhang is highest. These regions, including City Number 8, Simcoe and District, City Number 7, Quinte and District, and City Number 6, Brantford, represent the new affordability fault line. The homes that were affordable yesterday will become the debt anchors of tomorrow. The severity of the crash will be defined by the highest concentration of highly leveraged debt. The fundamental mechanic of the crash year is the payment shock trigger. Buyers who purchased here between 2020 and 2022 were operating with maximum leverage, often scraping together the minimum down payment and qualifying for mortgages only at historically low interest rates. Their financial buffers evaporated immediately after closing. As these 5-year mortgage terms mature throughout 2026, their new payments will skyrocket, in some cases doubling their monthly housing cost, consuming a dangerously high and often clinically unsustainable percentage of their household income. This is the moment financial distress turns into housing market supply. This coming wave of financial shock will unleash a flood of involuntary sales onto the market from desperate homeowners who are functionally insolvent at the new cost of borrowing. Simultaneously, many homes in these regions were bought by smaller, private investors chasing rental yield. Now, with new rental supply coming online and market competition increasing, the high carrying costs, insurance liabilities, and vacancy risks of these distant investment properties are turning cash-flowing assets into severe liabilities. When investors decide to liquidate to minimize losses and redirect capital elsewhere, that dual pressure of forced homeowner sales and investor exit strategies combines to create a sustained, intense supply surge that guarantees downward price momentum, pushing these highly susceptible markets into a full-blown crash by late 2026. The economic structure of these cities cannot absorb this sudden financial dislocation. Our countdown now zeroes in on the most active, high-volume secondary hubs of the Golden Horseshoe major economic cities, whose markets have been shattered by a sudden, massive oversupply of listings. These cities, City Number 5, London, City Number 4, Hamilton, and City Number 3, Kitchener-Waterloo, are all facing severe price pressure amplified by sheer volume and the collapse of buyer confidence. The bidding wars are dead. The discounting wars are here, and these regional engines are drowning in options, giving buyers permanent control over the negotiation and the final price. The core mechanic of the crash year is the sales-to-inventory imbalance and the deleveraging cycle. During the pandemic boom, these cities saw unprecedented price growth, often fueled by residents priced out of Toronto moving west and investors seeking higher yields outside the GTA core. The initial correction has already hit, with Hamilton, Niagara, and London recording significant early declines. But that was merely the start. The extended crash into 2026 is driven by an unprecedented accumulation of standing inventory. Major financial reports confirm that overall Ontario listings have hit decade highs, and in these regional hubs, a massive unabsorbed backlog of available homes, combined with years of severely depressed sales activity due to high rates, means the market has definitively shifted into a deep buyer's market. The critical sales to new listings ratio has plummeted far below the balance threshold, indicating a persistent supply glut. Sellers are now competing fiercely not just against new listings, but against the rapidly growing backlog of properties that have been sitting unsold for 6 months or more. For this glut of homes to move, significant and continuous price cuts, a crash by any reasonable definition, are required. This high-volume discounting cycle will suppress the benchmark price throughout 2026 as these major, debt-laden markets struggle to clear their historic inventory, ensuring painful losses for those who bought at the 2022 peak. We conclude with the two largest and most expensive debt engines in the entire country, where the scale of the financial contraction ensures a crisis-level event. City Number 2, Ottawa, the nation's capital, and the ultimate pressure point, City Number 1, Toronto. We've saved the two biggest financial dominoes for last. The crash won't be complete until the high-value debt centers crack under their own weight and wipe out the largest amounts of nominal equity, triggering broader economic fallout. The core mechanic of the crash year is high-value exposure and the condo conundrum. The fundamental issue is the scale of the exposure. A 10% decline on a $1.2 million property is a loss of $120,000 in equity, an amount that, in any other market, would be considered a severe crash. In Ottawa, the fragility is concentrated in the condo supply chain and the government sector. The city's multi-unit market is seeing a dangerous imbalance. A massive pipeline of under-construction condos, often pre-sold to investors, is set to complete and flood the market around 2026. Simultaneously, any slowdown or contraction in the highly influential government and tech sectors, due to fiscal restraint or a broader recession, will immediately impact high-end buyer demand. But the real crisis is Toronto. The GTA is the undisputed epicenter of the inventory avalanche and the mortgage shock. The city is grappling with record levels of newly completed, investor-owned condos hitting a market that is fundamentally unaffordable for end users, even with price declines. This has led to a major supply overhang, which, unlike other cities, is driven by the volume of investor units hitting the resale market. As financial institutions have noted, Ontario and British Columbia are the only provinces forecast to see continued average price declines into 2026, precisely due to this unprecedented high inventory, high debt environment. Toronto's crash is not a sharp one-time drop. It is a prolonged, agonizing repricing event with a combination of unsustainable debt, a glut of homes, and the disappearance of the young first-time buyer ensures that the most expensive real estate in the country continues its slow, inevitable descent, proving that even in the seemingly invincible GTA, economic gravity always wins.